It's a very good question. So I think if you divide it into two, first understanding what those global events may be, and then using your strategy after, right? So the first one is understand how global events affect the market itself. We can go down the rabbit hole of understanding how interest rates affect the market, the cycle of the economic, in terms of where we are. What we use practically speaking as traders is what we call risk sentiment, right? There's many topics you need to learn: safe havens, risk assets, correlations between the two. So, for example, the market correlations is very simply the statistical relationship of one asset to another, right? So the US dollar, the Swiss franc, and the Japanese yen are all known to be what's called safe haven currencies. So during market turmoil, whenever there's a massive event, for example, the pandemic was a great example where March of 2020, what we saw was a massive push in the dollar and a very much a big drop off in the equities. Equities are known to be risk on asset classes, and the term rotation is used, and that very is much so what we saw, right? A lot of the money being taken out of the equities, the risk on assets, and being put into these safe haven currencies. Moving forward, what you then want to do is understand what the market conditions are, right? But understanding what markets do in what conditions. So, for example, risk on, dollar in theory should be going down, equities should be rising. So if we're in our risk on condition, and many things can cause that to happen. You might have interest rates being cut, you might have a certain figurehead speaking, whether it be the central bank or a particular economic news event. And what you would then want to do in that situation is to understand how these different markets react to that condition. So if we're risk on, equities long, dollar shorts, euro longs. How you would tie your strategy into this is very simply understanding first and foremost where your strategy works the best. For me personally, I'm an equity trader. I trade using the 1 minute time frame, use a lot of volume. So if we are in a risk on environment, so dollar to go short, equities to rise, if we see that market direction occur, what I'm then practically doing is I'm looking for my strategy to meet the rules, right? Are we seeing that range breakout? Is the volume reinforcing that? And then my entry rules meet it. So once I understand what the market sentiment is, let's say we're risk on, if my strategy rules meet, right, the equity strategy I use, if those things are put together and they meet the rules, you then execute your trade and manage it accordingly based on where you are in the market. So to answer the question about how global events affect the market and how would you trade around it, you first need to understand very simply how these global events affect the financial markets, which is where risk sentiment comes into play, and then using your strategy to take advantage of it. That's a good question. I think it just depends on what sort of trader you are. I think one tool that certainly has been a huge edge for me personally is seasonality data as well as COT data, right? A lot of new traders might not know what they are and the utility of it, but these are huge tools. These tools itself give you such a huge advantage over others that don't, right? For example, the Commitment to Traders report, what it does, it gives you an active understanding of active buyers and sellers in the financial markets, right? All financial markets is a huge place of determining supply and demand. If we're able to understand what asset class is a huge demand, but actually seeing the active market makers buying and selling on a week-to-week basis, reinforce that with the historical performance of a market, which is where seasonality comes into play, and then use that information to then look at your marketplace and make trades. These tools itself will give you a huge edge, right? So the COT data, the Commitment to Traders report, tells you actively what's happening, who's buying, who's selling, at what rate. The seasonal data will then give you, as I said, a historical understanding of what price has done here in the past. For example, where we are now in sort of start of April into May, there's a huge seasonal bias for the dollar to go short. With that understanding, as well as the COT data reinforcing that, I can then look at the US dollar chart and with my technical analysis, understand if the price is starting to go short. If we are starting to see that market move short alongside the historical data with the COT data reinforcing it, that in itself gives me a huge edge. So again, to answer the question, tools that I've used that are very much foundational to my analysis has to be seasonality data, it has to be COT data, and then using the technical analysis to reinforce all that to dictate when to place those trades. That's a very good question. So this is the trade I took yesterday. So this was on the 8th of April, and this was a trade on the NASDAQ, right? And this goes back to the very previous question answered, right? What tools do we use to do the analysis and how do we do it? So Going into the week, you always want to make sure you do your weekly analysis, understand where charts are. So starting off the analysis process, the seasonality data needs to be used first. It gives you an understanding of what seasonal windows you are, what price is done historically. So where we are now in the start of April into May, the equities have a very big seasonal push, right, above 70% win rate over this period of time. So with that information alone, it tells me that equities tend to do well during this period of time over the last 20 years. So that sort of sets the path where price potentially may go. What we then want to do is then use the COT data and understand actively who's buying and selling, right? We have a lot of active sellers in the market at the moment. That negative correlation between the dollar and the equities will drive that equities higher if the dollar goes short, which is what we're seeing. So I've used the seasonal to tell me where we potentially may go. I'm using the COT data to actually see what's happening in the market right now. What we then want to do is make sure the technicals are where we are. If we look at the chart where we are now on the 7th, 8th of 9th of April, we're seeing prices moving from phase 2 from the daily potentially back into phase 1 on the daily time frame. So where we're at this turning point, naturally we'll see a lot of push buyers and sellers, but we look for that move back to the upside as the season will suggest. In terms of the actual trading date itself, going into 2:30, right? 2 p.m. is always when I want to make sure I understand what price is doing beforehand. So pre-market, we start to see the buyers start to tip higher. When the market opens, when the opening bell takes off, we want to make sure that the pre-market matches with the post-market. What you might see is pre and post, a lot of conflict between the two, where what might be happening before doesn't necessarily mean it's going to happen again. But what we did see in the pre-market into the open is we start to see the price start to go back higher. Me personally, the strategy I use a 1-minute time frame to look for specific patterns, ranges, breakouts, using the volume to reinforce that. And then on that day, yesterday, we saw that around 3 o'clock was when I saw my strategy rules meet, placed the trade. Now, the analysis we made at the very start, understanding that we're at a turning point, this analysis has dictated to me my management needs to be very aggressive. If we're in a trending market, if we're very early on going, I'm happy to let that trade run. But because I've had that awareness of where we are previously from the weekend analysis going into the pre-market, I understand we're at a turning point, and there's obviously going to be a lot of buyers and sellers. And therefore, the management needs to be very aggressive. Well, the last thing we'll do is be in a trade, have those buyers and sellers fight, and then it stops you out because there's the price turns. So going into that market, I was in that trade, met my rules, everything was looking good. It was in a bit of profit, closed it because I understand where we are. And then shortly after, we did see the market start to mess around a little bit more. So that was the whole process on yesterday's trade. But you can see the very start of the analysis started from the weekend, right? Of understand where we are on the trading day itself and then moving forward. So that is sort of the breakdown of that trade taken yesterday. That's a very good question. I think what you need to do is take total accountability of your own action, right? You can only worry and focus. You can only worry about what you're in control of, right? As long as you're doing what you need to do to the best of your ability, that's all you can do, right? So the way I like to break down a trade is in 3 main aspects, right? Number 1 is the market bias. Number 2 is the market entries. And finally, the management. These are the only things I'm in control of, right? If I get the bias completely wrong, let's say I wanted to buy a certain market and the market completely went against me, well, then I know what I need to focus on, right? I need to focus on the bias. I need to then look at solutions to make sure my bias is correct. Once I understand the bias is as good as it needs to be, and then focus on the entries, that's where I throw my strategy and work around that to make sure the strategy is as best as it can be. And then finally, it's of course the management. If you bank a trade, bank 20, and you make 20 points. Let's say, for example, the market is 100, you've only banked 150 for the move. So then the next question is, what can you do to improve on that? I say all this because these are things that you're in control of. These are things that you can actually work on, find solutions to these problems. And the more you focus on the process and you do it enough times and you see the positive results, that by itself builds confidence, right? Confidence without any work done is simply delusion. So I think what you need to make sure you do to help build your psychology is focus on the process, which you can use systematically time and time again. Do it enough times, get results from it, see what you need to improve on, see what you need to focus on. And that's where the breakdown of the trade comes in, because you can focus on what you need to focus on, what to improve on. And by doing that, you can then figure out what you're good at, what you're not good at. As long as you're doing everything you are doing to the best of your ability, as long as you're focusing on the here and now, what's going to happen is going to happen. Any mistakes you've done in the past stays in the past. Obviously, you learn from it. As long as you're staying focused on the present and making sure what you're in control of, you do to the best of your ability, there's no need to worry, or there's no need to be fearful or have anxiety of what's coming in the future, right? So focus on the here and now, focus on what you're in control of, work on solutions to make yourself better and making decisions. Because look, ultimately, as traders, we are decision makers. We make decisions to put risk in the market, and the analysis we do, the trades strategy we use, dictates where we put that risk. So that decision we make needs to be the best decision possible. And your job then, especially if you're learning, or even if you're at a high level, there's always going to be the things that you can use. But you're trying to focus on what decisions can you improve on. And that's obviously learning more and more. For more content like this, just give the account a follow, subscribe, comment. We do videos like this all the time, so I think definitely give it a follow, and we'll speak soon. Yeah? Boss.